When a company makes a big acquisition, we all tend to focus on the two companies involved, right? The buyer and the seller. But what if that's only scratching the surface of the story? Today, we're going to dive into the really fascinating world of M&A spillovers and see how a single deal can create these powerful, surprising ripple effects across an entire corporate family. And that really gets to the core question here. When one member of a huge corporate group makes a big play, does it lift all the boats for its sibling companies? Or does it introduce some new risk that could actually drag them down? Well, the answer is a lot more complex and, frankly, more interesting than you might think. You know, this quote from John Chambers just nails why this is so important. These days, companies can't just rely on innovating from within. To keep up, they have to go out and acquire new technologies and talent. That makes mergers and acquisitions this incredibly high-stakes game. The question is, who else gets affected by the outcome? Okay, so to really understand what's going on, we need to get a handle on two key concepts. First, what exactly are these corporate families? And second, what do we mean by these ripple effects or spillovers?
So a business group is pretty much what it sounds like, a corporate family. Think about a giant like the Tata Group. You have all these different companies, Tata Steel, Tata Motors, Tata Consultancy Services. They're all legally separate businesses, but they're all connected under that one huge Tata umbrella. They share a name, a reputation, and very often a lot of resources. And the spillover effect, well, that's the ripple we're talking about. It's when one of those family members, let's say it's the tech company, announces a big acquisition, and then all of a sudden, the stock price of its sibling, maybe a manufacturing company, starts moving too. The news spills over from one firm to the next. Which leads us to the most fundamental question of the research we're looking at today. Are these spillovers even real? I mean, when one company announces a deal, do the stock prices of its sibling companies actually react in a way we can measure? Is this a consistent thing?
Now, before we get to the data, let's just think about what common sense would tell us. There are a few pretty logical assumptions you and I would probably make about how this all works.
First off, you'd think that a deal made by the leading firm, the biggest, most important company in the whole group, the team captain, you'd think their moves would have a way bigger impact on the rest of the family than a deal by a smaller company, right?
And second, it just seems logical that the spillovers would be strongest between related companies. So if a tech firm in the group buys another tech firm, you'd expect the biggest reaction from the other tech-focused siblings. They're all in the same boat, after all.
And finally, what about geography? Going international is a big deal. It's riskier, but the rewards can be huge. So you would absolutely expect those bigger, bolder global moves to create much larger ripple effects across the entire family.
Okay, so those all sound like perfectly reasonable assumptions. But to know what's really going on, we need data. And this study went to one of the world's fastest growing economies and used a massive data set to put these exact ideas to the test.
And when I say massive, I'm not kidding. Researchers analyzed almost 4,000 separate M&A announcements. This isn't some small sample size. This is a really deep, comprehensive look at what's happening.
All those deals were spread across 43 different business groups in India. We're talking about huge household names here, like the Tata Group, Reliance, and Mahindra. And they collected all this information over a 5-year period, from 2017 to 2021. So this gives us a really clear and modern picture of how these dynamics are playing out right now. So how do they actually measure the spillover? They used a method called cumulative abnormal returns. Now, that sounds complicated, but the idea is pretty simple. They basically calculated how a stock was expected to perform on a normal day. Then they looked at how it actually performed right after a sibling firm announced a deal. Any extra gain or loss, that abnormal part, that's the spillover effect they were measuring. All right, so we've got our common sense expectations, and we've got this massive pile of data to test them with. And this, my friends, is where the story takes a really fascinating turn. Let's look at what the numbers actually showed us. So the first big finding is a huge confirmation. Yes, spillover effects are absolutely real. When one firm announces an M&A, the sibling firm's stocks definitely react. And what's really interesting here is that the effect is overwhelmingly positive. It's like good news for one is seen as good news for the whole family. But this is where things start to get weird. Remember our first assumption that a deal by the team captain would have the biggest impact? Well, reality check. The data showed no significant difference. A deal by a smaller firm in the group created just as much positive buzz as a deal by the family's biggest star.
And what about industry? We were pretty sure spillovers would be stronger between related companies. Reality? Nope. The data disagreed again. The positive ripple effect on a sibling in a completely different industry was just as strong.
Okay, how about our last assumption, that those big, risky international deals would make bigger waves? Well, the reality was no significant difference there either. A local, domestic deal created just as powerful a positive signal. So the big question is, why were all of our logical assumptions wrong? It turns out the answer isn't in the details of the deal at all. The answer lies in the incredible power of the corporate family itself. The reason those specifics didn't seem to matter is because something much, much bigger was at play.
So why didn't those details matter? It's all about the brand. First, the reputation of a group like Tata is just so powerful that any M&A deal is seen as a sign of strength for the entire family. Second, investors aren't naive. They know these firms share resources and capital, so a move by one implies good health across the board. The market basically sees the whole group as one big entity, so a win for one is a win for all. And in a fast-growing market like India, the stability of that family brand often means more than the nitty-gritty details of any single transaction. And that really brings us to the core insight of this entire study. The signal sent by the family name is so strong, so credible to investors, that it pretty much drowns out all the other noise. It doesn't matter who in the family made the deal, in what industry, or where in the world. The action itself is a signal of collective strength, and that's what moves the market. This leaves us with a really fascinating thought to chew on. In this interconnected world of massive corporate families and powerful brands, it raises a pretty profound question for all of us, whether we're investors or strategists. Is it possible that your success is now defined less by your own individual actions and more by the strength and reputation of the family you belong to?